Hey, folks, welcome back to another episode of Advisor Insider. I'm Jeff Benjamin, Wealth Management Editor here at ETF.com. And I'm talking today with Dhruv Nagrath, Director of Fixed Income Strategy at BlackRock. How you doing, Dhruv?
I'm doing well, thanks, Jeff. How are you?
I'm doing great, and thank you for being here. There's so much going on right now in the fixed income space. It seems like the excitement has come back to this space. I know it probably for somebody like you, it's always there, but I look at it right now and I see the money moving in. I see the people that were pouring into some ETFs like TLT, the 20 plus year Treasury ETF for a couple of years, and now they're maybe finally there at the right time. Anyway, let's kind of break it down. I want to set it up by saying it, a Morningstar report came out this week showing $93 billion went into bond ETFs during the third quarter. That's a lot of money, and money is moving out generally of equity ETFs, or the net flows are lower, but that's a little bit skewed with Morningstar data because they include mutual funds with their ETFs in some of their data. So uh, mutual funds have been kind of bleeding assets for a while, but that's a separate story. So, Drew, put this into a little bit of context for us. What is the deal? What is the big appetite all of the sudden for bonds?
Yeah, thanks, Jeff, and I really appreciate the opportunity to be here and to speak with you and your audience. I think you're right in saying that there's a lot of excitement about fixed income, and you're right also in saying that uh, unlike what the stereotype is of a bond guy, I'm always excited. I'm not all doom and gloom. I'm always excited about fixed income ETFs. The longer term structural story is one of transformation and modernization of the bond markets, and I can get really excited and geek out on that. But
Mhm.
I will focus a little bit more on what specifically we're calling out, which is this recent trend and this uptick of flows in the recent past. I think the first and probably most powerful reason to look at the flows in fixed income is just the fact that you can make money in fixed income again.
Mhm.
I think this is the silver lining of all the pain that we felt in 2022, right? Is that you had
Right.
this complete reset, this complete reimagination of the fixed income investing environment. Maybe I'm not senior or qualified enough to say it, but I'm going to say it anyway. Like, Rick Reeder, our CIO of fixed income, says it. It's a golden age for investing in fixed income, and I can see why. You can put money to work in a multi-asset portfolio context, and you can hit your yield targets um, fairly fairly easily, like in the
Mhm.
sense that you've got a lot of your legwork being done in fixed income is being done by your risk-free rate, which is obviously at a higher level than it has been for decades. We wrote about this in a paper earlier this year called No Time to Yield. And to save you having to read the paper, the key point is that there's this enormous opportunity in fixed income. And you really don't need to reach too far along the risk spectrum to make that money, right? That's kind of the key message. So I'd say that's the first and most powerful reason is the opportunity set.
Mhm.
The second thing, I would say that there is a kind of a rethinking of how do we build portfolios in fixed income. And you kind of called it out. There's been a little bit of a shift from mutual fund assets into fixed income ETF assets. And this is it's not my place to bash one structure or another, but it is fair for me to call out that more investors seem to be adopting the ETF structure because of some of the benefits that have been well documented. And I'm sure you've spoken about it on your podcast before,
Mhm.
but things like the access and the efficiency and the liquidity and potential tax advantages. These are things that a lot of investors out there are kind of drawn to, especially the model portfolio based investors. So that's if I had to call out another big trend, there's just an enormous um, sum of money now being moved around in markets by model portfolio managers, and there are various different advisors who subscribe to these models, right? And so
Hmm.
I was looking at some Cerulli data a little bit earlier on, and the overall kind of there's about $4.2 trillion in model portfolios today. That's Cerulli data. That's according to them, and they think it's going to grow to about $11.5 trillion over the next 10 years or so. So, and then the advisor usage of model portfolios has steadily increased. It's basically doubled in the past 3 years. So, so I think that is another driver, another thematic. So let me pause there. I've thrown a few
Yeah, let
different things
me
at you. Yeah,
let me
but
ask
yeah,
you, you talked about reaching into or I guess down the yield curve in the fixed income side. I mean, if you're at the point right now, you're a financial advisor, your clients have maybe more cash than you're comfortable with, and maybe they should be comfortable with, or if they've got new money or their normal investments, where would you start to allocate, or where should someone start to allocate along the bond curve? Because there's been so much, or yield curve, I'm sorry. There's
yeah.
been so much, such a good opportunity to sit in cash. And we keep hearing as interest rates are going down slowly that opportunity is going to go away. I frankly don't think it's gone yet. But where do you see the opportunities right now? Because you can go too far, right? Especially with this inverted yield curve.
Yeah, the inverted yield curve, Jeff, is probably the biggest reason why so many clients have been kind of hiding out at the short end of the curve. And I take your point. One of the things that we will often cite from our side is the fact that there's $6.4 trillion sitting in money market fund assets, and that number has stayed kind of constant throughout the year, and it's product of this hiking cycle, right? And you saw a lot of money going to the short end of the curve, going into money market funds, because for once you were earning yield again. That's kind of the driver I called out earlier on. What we do call out for our clients, just out of a sense of prudence, is when the Fed does start cutting, as we know, they did a 50 basis point cut, and they are. Market expectations are for more cuts by the end of the year. They've been tempered a little bit, but what happens is the short end of the yield curve does come down, and it can move down quite rapidly. And that does create a reinvestment risk for clients. So we've been talking about this for a little while. We might have been a little bit early to talking about it. We've been
Hmm.
starting to talk about it since actually last summer. We were conscious of the fact that markets can move quickly. The short end of the yield curve can come down quickly when the Fed starts cutting rates,
Uh-huh.
uh, and that creates a reinvestment risk. And so, to finally get to the point of your question, where do you start to put money to work?
Right.
We do think that now is a time to start stepping a little bit further out the yield curve in terms of maturity. And the best opportunity for us is at the belly of the curve. Now, broadly defined, you could call that 3 to 7 years. We have a treasury ticker with the ticker IEI. That's one way to play it.
Uh-huh.
Um, but if you had to kind of force me to pick a point of the curve, say the 5 year mark of the curve, where we think that the trade-off that you get in terms of the yield at that part of the curve, balanced with the amount of duration risk, the interest rate risk that you take on, we think that's a kind of a fair trade-off for in terms of both in terms of the yield opportunity as well as potential price appreciation you can get. When the cutting cycle continues. So that's kind of the sweet spot for us. You mentioned, how far do you reach? And I think your point is well taken. We don't believe in the idea of going too far out in
Uh-huh.
in reaching for yield along the maturity spectrum. So 10 years and out, we're actually a little bit wary of that part of the curve, because there's a greater degree of volatility at that part of the 10 years and out, basically because of the market's fear around the government's ongoing borrowing needs. And we obviously have a big event coming up in a few weeks in terms of the election, and without trying to prognosticate about the outcome, we do know that both sides, in some way or the other, are going to be either taxing less or spending more.
Hmm.
And what that means for the fiscal position is more borrowing, right? And so that's why we're a bit wary of what happens to treasury prices 10 years and out. There's greater volatility that you introduce at that part of the curve. So we think the sweet spot is the belly of the curve. And that would be the first step in terms of, client portfolio positioning. That's what we're talking about is intermediate duration.
Uh-huh.
But I will say for your clients, Jeff, who have their clients, their and investors who are sitting in cash, maybe that first, that the first step might not be one all the way out into the belly of the curve. It could be into like an ultra short exposure, like on our side we have an active ultra short product called NEAR. That has a duration at about 1.8 years, and it's got a healthy yield around the 4.6% level. That could be a way to do it. Get a bit of spread, get a bit of bit of yield, but have the potential for some price appreciation. So, there's an entire spectrum, and I think, just maybe stepping back and looking at the overall fixed income ETF landscape, your toolkit now is more advanced and more precise than it ever has been before. And so, what I'd say, what I encourage to your listeners, Jeff, is just really, grill your ETF issuers on all the range of offerings they've got, because chances are you're going to have something that will help you target what you're trying to do in a portfolio in an ETF format.
How much of what you're talking about right now, as far as going out on the yield curve, the belly of the curve, is influenced or could be influenced by Fed policy? There's another Fed meeting coming up. I think it's right before the election, correct?
Yeah, that's right.
They're obviously, it seems like everybody is expecting another rate cut, but can you kind of fold Fed policy or your outlook on Fed policy into that thinking of kind of moving out on a yield curve a little bit?
Yeah, sure. Yeah, very happy to do that. Look, our expectation is that the Fed continues its cutting cycle, but 25 basis point cuts are more likely and more warranted. The what we've got in the broader macro context, in our view, is an economy that is strong, stronger than expected, as well as you saw by that, based on that recent jobs number a couple of weeks ago. And then that, the inflation readings that came through last week, which were, both on the headline and the core levels. Headline was at 2.4%, and then core was at 3.3%. Both of those readings were a little bit stronger than expected.
Hmm.
And the broader story that we have is an economy that's stronger than expected. But overall, the policy setting is one that was at quite a high level. And if the economy is starting to normalize and the Fed is moving to, the inflation is moving closer towards the Fed's target, maybe with some bumps along the way. If the economy is starting to normalize, then the policy setting of monetary policy should also start to normalize. So this is not like an easing cycle. It's more of just a calibration cycle, right? If you were thinking about it that way. So anyway, but point is, we think by the end of the year, you've got two more cuts that are likely, 25 basis point increments. Of course, we have more data readings between now and then. And then to answer your question, what does that mean in terms of, in terms of policy? Look, the Fed has more impact on the short end of the curve.
Hmm.
The long end of the curve is more affected by the economy's or the market's expectations of future growth, inflation, and of course, the issuance of treasuries at the further end of the curve. So that's why, we talk about that 5-year point. Right now, it's yielding you 3.84%. We talk about that as a bit of a sweet spot where if bonds at that part of the curve rally, you're getting yourself, it's not a full 5-year duration, it's a 4 point something duration. You're getting a potential kicker from price return, while still having a yield cushion that, if say you have a strong inflation print, or you say you have a need for rates to, markets kind of, bond markets sell off, you still got a yield cushion. So that's why we talk about that part of the curve. It's kind of the right kind of risk reward trade-off. So how does that look in terms of portfolio? That's where the portfolio positioning is.
Hmm.
For a lot of clients, that's kind of what they're either, you know, that's where they're at in terms of my conversations, or that's where they're kind of trying to calibrate to, is around, around that 5-year mark. The way that we've seen it in terms of flows, in the ETF landscape, it gives us a good reading of where flows are going. The number one asset gathering category across the industry is the broad multi-sector exposures, right? The ones that track the ag, right, or the Bloomberg aggregate, which has a duration of about 6 years.
Hmm.
That is an intermediate duration, right? So year to date, you've seen about $220 billion into fixed income ETFs. $75 billion of that has gone into ag-like exposures, whether it's an AGG or an IUSB, which tracks the universal, so has a little bit of more spread. But those kind of broad multi-sector ag-like exposures is
Are they
that's
mostly
yeah,
passive strategies, indexed
largely
bond fund?
index strategies. Yeah, the bulk of those flows, those ETF flows, are largely into index exposures.
What is your thinking on active versus passive when it comes to moving into the bond markets like we're talking about right now?
Yeah, we so for us it's no versus. It's not a versus at all. It's an and we also don't say passive, not to correct you or anything, but we tend
Uh,
not to say passive because uh the process of portfolio management, whether you're in fixed income, whether you're trying to beat a benchmark, you're trying to track a benchmark as closely as possible, just because of the quirks of the bond market, we actually think that index investing in fixed income is very sophisticated,
mhm.
and there's a lot of nuance to it, which I won't bore you or your listeners with, but I encourage them to reach out to us if they're interested in learning about why. But in between that spectrum of index and active, we think that right now it's such a great time to be a fixed income investor using ETFs because you can do everything
Uh-huh.
in the ETF wrapper. But then to answer your question more specifically, the way that I like to think about it is index. You don't need to overpay to have market exposure. You can get something like an AGG, for example. It's a $118 billion fund, tracks the Bloomberg Aggregate Index, and it charges you 3 basis points per annum.
Hmm.
You've got exposure to over 10,000 line items, and it tracks that benchmark within basis points. I mean, it's phenomenal. It's a beautiful thing. And then you could pair that, with something that's more active and trying to do things around that. We've seen a lot of success in our flexible income ETF run by Rick Reeder's team, BINC, the BlackRock Flexible Income ETF.
Uh-huh.
Um, that's something that plays in the plus kind of sectors of the market where you might not want to make those calls yourself. Do I want to buy CLOs or do I want to buy European high yield or EM debt? I see a lot of advisors saying, I'm happy to outsource that decision. And so, I think we think that index and active work really well together. And index lets you get market exposure at a really low cost in a very efficient and liquid way. And then active investing lets you add value in places where you might either not have the resources or the expertise, or just might not have the time to do that. So we think that they pair really well together.
Okay. I want to talk to you a little bit about some of the risk of moving into the bond market right now. And
Mhm.
we're saying this from the perspective of maybe somebody's in cash or maybe somebody's really short term in these bond ETFs.
Mhm.
And even if that risk is that, well, you might be able to make a lot more money in the stock market right now because this is still a bull market. So
Yeah.
can you kind of lay that out for me? What risk are you facing by moving, let's say, in the belly of the curve?
So what risk are we facing relative to investing in stocks? Is that the question, or?
I guess relative to investing in stocks is a little bit of a difficult one because
Yeah,
they're two different animals. But I'm
yeah,
just saying there's no guarantees out there.
yeah.
Is a risk that the Fed doesn't cut rates? Is a risk that we go into a recession? Is a risk that things get so bad that the Fed has to raise rates? I don't know.
Yeah, yeah. Look, it's funny. There's all kinds of risks that are out there at any given time, and you've seen pick up in things like the VIX index through some of the geopolitical events, and then as we get closer to the event risk of the election as well, there's been just a bit of greater uncertainty priced into the market. What we do right now have a pretty clear picture of is that the economy is in a relatively strong place. You can make decent yield in things like credit markets. The valuations are a bit tight, but the fundamentals are pretty strong. And the thing is, you don't need to overreach to hit your yield targets. Where's the risk though in fixed income? I mean, one of the ones I called out earlier on, and I think I've beaten the point to death, so I won't overdo it. But it's like is fiscal deficits, right? So that's a concern that's very live in our minds in terms of the long end. Um, but in terms of the macro picture, Yeah, look, you could see a reacceleration of inflation if, for example, some of the trends around a big fiscal impulse or geopolitical risk kind of can feed through in a bigger way. You could see an acceleration of inflation. You could see a reacceleration of shelter inflation. I live in New York City. Uh, the rental market is still crazy. Just based on the
Hmm.
anecdotal experience I'm seeing amongst my friends. Um, and then yeah, so you could see a bit of a reacceleration of inflation, and how does that play out with reference to your question? Um, you know, that's where you want to be wary of how you're sizing your kind of your risk in fixed income. But we're not saying back up the truck and buy 20 plus year treasuries all the time, even though clients have been buying them.
Hmm.
What we're saying is you can be measured and you can add a bit of step out in duration, because we suspect that that's a decent way to react to this market environment, right? So
Hmm.
yeah, look, overall, there are risks out there, but the reward and the opportunity that you're getting right now in fixed income is one that is looking pretty attractive, and that's definitely why clients seem to be
Okay.
uh, allocating.
Let's talk about bond laddering.
Yeah,
It's one of my favorite topics because I
sometimes.
you can get different answers from everybody on this one. Does it make more sense to ladder or just, buy yourself some bond ETFs and hold them? I've heard people say that laddering is really it's kind of a wash in terms of a difference. It's just psychologically financial it makes investors feel a little bit better because it's kind of easy to understand. You can see where these things mature and roll off, and you've got a decision to make. A lot of times I also hear that financial advisors like laddering because it allows them to actually do something on the fixed income side, but it's not that difficult to do. I'm not saying it's simple, but it's easy to explain, it's easy to understand, and it works for the most part for what you're trying to get. But what are your thoughts on laddering and laddering strategies?
Yeah, yeah, I agree with your earlier comment, Jeff, that if you set up similar outcomes with a perpetual ETF or a ladder strategy that ultimately has a similar kind of duration, and you held them over similar periods, we've done some number crunching to show that you could wind up in a similar place. But I
Hmm.
think I mean, and that's assuming not too much customization with the ladder. But I think you hit the nail on the head where you talked about the client experience, right? For me, that's where I speak to hundreds of financial advisors across the country, and they do seem to give me this feedback that clients like that more defined outcome experience, a more predictable experience. They want a bond-like experience, but they still don't see the benefits of bond ETFs, and so
Hmm.
yeah, for us, we've seen a tremendous amount of success in our I bonds term maturity ETFs. Over the past 3 years, we've basically seen the assets under management in that product set triple. So triple in past 3 years. We've just over $32 billion in assets. And what those products do is exactly what we're talking about right now, is they let you build bond ladders.
Uh-huh.
And actually just you're terming out your interest rate risk over these different rungs. There's a whole variety of use cases. There are some clients that'll just target a particular maturity date because they want to buy a holiday home, or they want to save for a child's education, or whatever it is. Um, or there's the more traditional bond laddering use case, which it lets advisors show that, hey, we can set you up, we can have your regular your distribution payments, and then you can have these maturities. It does give a little bit more of a bond-like user experience. So I agree with your comment that I think you can wind up in similar places using
Hmm.
perpetual or term maturity ETFs. But from a client experience perspective, we've seen a lot of interest in these suites. The bulk of the assets are going into IG corporates, investment grade corporates. I think year to date, looking at the numbers, we've seen about 5.1 billion into IG corporates. And then the next category is treasuries, about 1.3 billion.
Hmm.
It comes back to the point is it's more about the user experience and the kind of the more
Hmm.
defined maturity experience.
Yeah, well, the ETF space has certainly done a lot to make laddering easy and possible. I know you guys even have something on your websites a
Yeah.
tool to help you break down what kind of laddering might work best for you. And actually, I'm going to put that in the show notes. I'll link that in the show notes so people, if they want to track that down and mess
Yeah.
around with it. I was messing around with it a little bit earlier today to check
It's
out and
fun.
try and see where. Yeah.
It is fun to play around with, and it does
Mm-hmm.
give you a visual to work with. One other thing I was going to say is that it kind of also aligns to some of the themes that we were talking about earlier on,
Mm-hmm.
where, we were talking about an inverted yield curve, and you can see that on the tool, and it actually aligns to where the bulk of assets have gone as well as to the short end of the curve. So
Mm-hmm.
the flows have chased the yields, and the yields have been at the short end of the curve, and you can kind of see that the visuals are pretty neat.
It's good stuff. I'm actually looking at it right now. But Drew, I want to wrap up with a kind of something that you mentioned earlier. You talked to a lot of financial advisors. Just kind of briefly give us a sense for what you're hearing out there from financial advisors.
Yeah, it's some of the themes that we talked about are, I guess they're front and center. I mean, laddering, we've talked about it, so I won't overdo it, but that's definitely
Mm-hmm.
been a topic. It's, I would say, over the past 2 or 3 years, the that iBonds product set is the is the product set that tends to dominate my team's energy and attention, because
Uh-huh.
clients are asking us about how to build these ladders and customize them. But if I broaden it out, three key themes that I'd call out that are kind of hot topics. Theme number one is that duration question. And I think there are a lot of advisors out there who are a little bit gun shy on duration because of just the experience with 2022. So that was a hard one, and so that does become a big part of discussions. And we've got some commentary around it. Our investment strategy team published a note called investment directions for fall that maybe I can share with you as a follow up. To link to that basically spells out our thoughts on that point. Some of the points that I've discussed earlier on will come up. The other one is the fact that spreads, right? So the additional yield compensation you get for taking on credit risk so for example, credit markets, spreads are tight. IG spreads are at 80 basis points
Mm-hmm.
above treasuries, and high yield spreads are at 290 basis points over treasuries. These are well inside of their 5-year averages. And so valuations in the credit markets are tight. But the fundamentals, like I said earlier on, are pretty strong. The economy is in a pretty strong place, and that kind of supports the credit markets. So one of the themes that's come up is, how do we get a little bit smarter about how we access those markets? And something that's been really popular there is systematic ETFs that screen out riskier bonds and then tilt towards undervalued bonds. So there's a couple of tickers there. HYDB and IGEB are interesting ones to look at. For clients that want a little bit more of a thoughtful approach about targeting credit markets. And then, look, you called it out. The third one, I'll say, active ETFs. A lot of clients asking me, what's the deal with active ETFs?
Mm-hmm.
Is it an either or question? And I think that, like I said to you earlier on, it really depends on what you're trying to achieve. We think that they can work really well side by side. And the opportunity set in things like BINC that are going out there and capturing value in the fixed income markets, it's a pretty interesting and attractive time to use them alongside your index exposures.
Okay. I think that's where we're going to wrap it up. Drew, what do you think of
Okay.
that?
That sounds great. I've appreciated the time, Jeff. Thank you so much. You've let me just geek out on all the things I talk about all day. So thank you for entertaining me.
Well, thanks for being here. Really good stuff. I appreciate it. I'm always trying to give our audience more bond math, as I call it, because it's
Nice.
fun and it's not always intuitive for people. So hopefully we're
Yep.
walking people through it in a pace that's comfortable for everyone. I want to thank Dhruv Nagrath, Director
Yep.
of Fixed Income Strategy at BlackRock. Good stuff. Thank you very much for being here. I'm Jeff Benjamin, Wealth Management Editor here at ETF.com, and you're listening to Advisor Insider. Thank you very much.